I'm going to be discussing primarily in this video the current money market fund yields, which is an update from an earlier video that I published about 1 month ago titled Treasury Bills versus Treasury Money Market Funds that I will link in the More section below. Before delving into that topic, I have recently expressed in some comments that my inclination is to wait until more clarity is provided about whether Trump will actually do what he said he would do after becoming president before making any significant portfolio allocation changes. I will not have to wait long to know those facts as to whether or not he actually goes down the path that he said he was going to do. The primary areas of my concern, at least, near term, are whether Trump starts a trade war by implementing tariff increases on a broad range of imports, and whether he also starts, at the same time, the mass deportation of undocumented immigrants who contribute to U.S. GDP growth, pay sales taxes to state and local governments, and fill important roles in the U.S. supply chain, particularly in the agricultural and food sectors. My opinion is that the current stock index levels, primarily referring to the S&P 500 there, reflect a belief that Trump's campaign promises were mere bombastic bloviations from a demagogue, and Trump will end up doing very little that upsets the stock investors after becoming president. If Trump backs off his campaign promises, for example, and limits deportations to criminals, then the economic impact would not be meaningful. Immaterial would be another word. If employers start having their labor force decimated by the deportations, particularly in the agricultural and food sectors, then that is something that will have profound negative economic impacts and will need to be taken into consideration when making my personal investment decisions. Waiting to see what actually happens is the most prudent course for me now. I'm just speaking for myself, particularly given what I consider to be elevated valuations in the stock market already, and the potential for a bear market starting within 12 months if the economy starts to go south. Holding substantial amounts of cash in money market funds, which is the main topic of this video, over an extended period of time is a significant risk for most people. They may not look at it as a risk because the money is generally safe in those funds. The practical risk is that the fund will never be able to deliver a total return after taxes and adjusted for inflation that is necessary for most people to meet their financial goals, including its sufficient funds to pay expenses during retirement. So that's a risk if you don't meet your goals because you fail to take the necessary risk along your adult lifetime. Most of the time, the yields of the money market funds, in my life as an investor when I've used them, have failed to provide a positive return after taxes and adjusted for inflation. The best results have frequently been that the after-tax inflation-adjusted return is barely positive for a time as now. While many of the money market funds were paying over 5% prior to the Fed starting its rate cutting cycle including the one I used at Vanguard, which was topped out at about 5.4%, as I recall. Their yields have adjusted quickly down to reflect the Fed rate cuts in the federal funds rate. To maintain a $1 constant net asset value per share, these funds cannot take duration risk by investing in intermediate or long-term securities, and will own securities that will fully reflect a Fed rate cut in 30 to 50 days when they all have matured that they owned prior to the rate cut. But the yield will start to go down shortly after a rate cut and will simply stabilize within 30 to 45 days generally at whatever the amount of the rate cut was. The last rate cut, which was 25 basis points on December 18, is not yet fully reflected in the 7-day yields of money market funds. The 1-day yield, which is generally not provided, will be lower than the 7-day yield after a Fed rate cut until all the securities owned by the fund prior to the cut have matured, and then the yields stabilize until the next Fed action. It needs to be mentioned when deciding what to do now that the federal funds future contracts and a majority of Fed members believe that there will be two 25 basis point cuts in 2025 as the more probable than not prediction. If that happens, then the 7-day yields that I'm about to provide will be 50 basis points lower within 30 to 45 or 50 days, depending on the fund's weighted average maturity after the second such cut in 2025, assuming both occur. I'm about to list the 7-day yields for just the funds that I own in my brokerage accounts. In Fidelity, I own SPAXX as my sweep account. The current 7-day yield is 4.1%. The expense ratio is the highest of all the funds that I own at 0.42%. I generally do not keep much money in that account before redirecting it to purchases. The Schwab sweep account is ridiculous. It pays like 0.2%. So if you want an alternative to that sweep account, you have to buy one of their purchased money market funds. I do currently have some money in the Schwab SNOXX fund, which has a 4.17% 7-day yield, which is 7 basis points higher than the similar Fidelity fund because the Schwab fund has a lower expense ratio. I'm expecting those two funds to fall close to a 3.95 to 4% yield when the last Fed rate cut in mid-December is fully factored into all the securities that the fund owns after the ones that they owned prior to the rate cut have matured. The Vanguard fund, which is similar in what they own to the Fidelity and Schwab funds that I just mentioned, is VMRXX, and it has a 4.52% 7-day yield. That is the Admiral class, which currently has a 0.2% higher 7-day yield than the investor class that has the symbol VMFXX. The Vanguard Admiral fund has a slightly higher yield than the investor class simply because its expense ratio is 0.1% compared to 0.11% for the investor class. But the reason that both of those funds have much better yields than the similar funds offered by Fidelity and Schwab is that the Vanguard funds have a much lower expense ratio. The purchased Schwab money market fund that I own, SNOXX, uses repurchase agreements in addition to owning treasuries directly. Income derived from repurchase agreements that involve U.S. Treasuries will be taxed by states with income taxes. And 3 of those states, as I recall, will tax the entire amount paid, including the income derived from direct ownership of treasuries, which is a bummer. When over 50% of the distributed income is sourced from repurchase agreements, a topic that I've discussed in prior videos. Schwab does have a fund that generates almost all, if not all, of its income from direct ownership of treasuries, thereby avoiding that issue. So the symbol is SNSXX. If I lived in a state with an income tax, and I do not, I would use that fund rather than SNOXX. It doesn't make any difference to me which one I own, since I live in Tennessee and we don't have an income tax. When Treasury money market funds are falling, which has been the case, starting with the 50 basis point cut in the federal funds rate in September, more income can temporarily be derived by using a short-term Treasury bill ladder instead of owning the money market fund, which would include 1 to 4 month Treasury bills bought at auction. But this is only a temporary solution, particularly when the Fed continues its rate cutting cycle. Those who are relying exclusively on short-term investments like Treasury bills, CD, and savings accounts will see a continuous decline in interest income. When that decline stops is anyone's guess. It just depends on what happens in the economy and how the Fed responds to it. I mean, it's certainly reasonable if the economy tanks in a big way that we'll be back to ZIRP at some point in the future. I read a comment from someone that he had a bond ladder consisting of 1 to 6 month Treasury bills. That is not a bond ladder, but an alternative to earning more income than a Treasury money market fund when yields are declining due to Fed rate cuts. My primary fear is that the Fed will at some point return to ZIRP and QE, and Treasury bills will again sink back down to near zero where they were for an extended period of time during the Fed's jihad against the saving class, who were in effect forced to pay for the mistakes made by the richly compensated masters of disaster that caused the 2008 near depression and paid no penalty for it, and the long period of recovery that kept rates near zero thereafter. Since I cannot predict the future and must recognize that the low interest rate regime may return when economic conditions are dire, I have a bond ladder that covers a broad maturity range. The ladder is currently weighted at the short end, but that includes maturities in the 1 to 3 year range. The long end part of it are primarily 8A better or rated Tennessee municipal bonds that can be called at par value 10 years after issuance. And my short-term bond ladder that is primarily invested in corporate bonds that mature in 1 to 3 years can cushion the result on lower interest income for a while after the Fed starts a rate cutting cycle. And I'm starting to go further out now, both in Treasury note and corporate bond purchases. And further out, I mean, I am talking about maturities in 2027 to 2023, but the amounts are currently insignificant. And I will be discussing some of the Treasury note purchases that I've made within the past week in my next post.